Bismillahirrahmanirrahim. Assalamu alaikum, dear students. I hope all of you will be fine. Dear students, I welcome you all again in our subject accounting for managers. Today we will continue the topic that was regarding classification of cost, which we had studied in our previous session as well. So regarding classification of cost, we have studied that we group cost into different segments, different groups. Cost can be classified in a number of ways depending on the purpose of the classification. It depends upon that why we are classifying the cost. So cost we classify based on what? Based on our purpose. Remember students, we have classified cost in our previous session based on functional or divisional classification. Then we had studied the cost elements, that was direct material cost, direct labor cost, and FOH cost. So that was the elements of cost. Today we will proceed to discuss cost, classification of cost in the relation of the product, controllable and uncontrollable, and classification of cost according to the accounting period to which they apply, and so on, inshallah. So cost in the relation to the product, what we say that we classify, we group cost on a product that may be direct and indirect. Mean the cost incurred on a product which we offer, or product or service which we offer for sale, right? So we can group the cost into direct cost and indirect cost. As we studied in our previous class, the direct cost includes direct material cost, direct labor cost. Indirect cost include indirect material cost, indirect labor cost, and other indirect cost or other overhead cost. So we have studied in very detail regarding the direct cost and indirect cost in our previous session. If any of you are watching this video, so I will suggest that kindly watch the previous video which we have developed for the beginning of our session. Now dears, what we say regarding cost in relation to the product, we say that on every product or any service which we offer, two kinds of cost will incur. One will be direct cost and the other one will be indirect cost. So if in our organization we want to find out that what are the costs incurred on a particular product, say we will continue the same example of chair. Suppose we have manufactured a chair. Now the cost incurred on that chair, that product, that may be direct cost, that may be indirect cost, direct material, direct labor cost. So on a chair, definitely direct material cost and direct labor cost will be incurred, as well as the indirect cost. Indirect mean indirect material, indirect labor, and other overhead cost will be incurred on that chair. Now the direct cost of the chair may be, or that may be we say wood and steel, right? Direct material cost, right? And direct labor cost mean the salaries and wages paid to the carpenter. That was the direct labor cost. So that is the direct cost. Whereas the indirect cost mean indirect material, indirect labor, other overheads. So indirect material of a chair may be what? Suppose the nails which we have used in manufacturing a chair, the color or the glue. So that is the indirect material cost of that chair. Indirect labor mean the cost, the salaries and wages paid to the supervisor, inspector, the guard, and so on. So that is the indirect labor cost. So that will be definitely incurred on a chair on that particular product. And other indirect cost includes, that is factory rent, depreciation, electricity, and so on. So these are the indirect cost of a product. So what we do in order to segment, in order to find out the cost on a product. So what we do, we classify cost on the basis of direct cost and indirect cost. So this is another classification of cost. So that is direct and indirect cost. The other one is the controllable and uncontrollable cost. Controllable costs are those which we can control in our organization, right? Whereas uncontrollable costs are those which cannot be controlled. For example, designated level of authority in an organization. For example, work manager is responsible for material consumed, not for material price rent of the department, because the price of material, who is responsible for the price of material? That is the procurement department, procurement manager, right? So the procurement manager will set the prices with the vendor, rent of the building with the administration. So what we say, in an organization, as per the designated level of authority, we can control some of the cost, whereas some of the costs are beyond our control. So we classify cost on the basis of controllability and non-controllability. Whereas the other type of cost is cost on the basis of accounting period. Now there's accounting period to which they apply. So what we do, suppose if in our organization we are finding out cost, so what can we do? We can classify cost based on what? Based on the accounting period. Now this is accounting period, also known as accounting, or also known as financial period or fiscal period. Now by accounting, financial or fiscal period, we mean any period mean time. So any period of time, any period for which we calculate profit or loss for our firm. So that period is called accounting period. Clear? What I say? By period we mean time, accounting, or also called financial or fiscal period. So accounting, fiscal or financial period is date period. So period mean time. So any time. Time may be 1 month, the time may be 3 months, the time may be 6 months, the time may be 9 months, 1 year. So any period of time for which we calculate profit or loss for our firm, that period is called accounting period. That period is called accounting period. There is another term, accounting year, fiscal year or financial year. So when we use the term fiscal year, fiscal or financial year or accounting year, so look there, here we have used the word period, and then we are using the term year. So year mean what? Year mean 12 months. Year mean 12 months. So when we use the term accounting year, so it means that we are calculating profit or loss for our organization for 12 months. 12 months mean for 1 year. So this is the main difference between accounting period and accounting year. So in accounting period, the time period may be any period of time for which we are going to calculate the profit or loss for our firm. Whereas in accounting year, we do what? We calculate profit or loss specifically for 1 year. So there's what we do. We classify cost in our organization based on accounting period to which they apply. Suppose the total cost incurred in our organization, in our factory, sorry, that is 12,000. So 12,000 is the total cost of what? Of our year. Now what we are doing? We are classifying the cost on quarterly basis. Quarterly basis mean for the first 3 months, January, February, March. Till March we calculate cost, right? Then for April, May, June we calculate cost. Mean we are going to divide the cost into quarter. So the cost of each quarter may be 3,000. Why? Because we have divided 12,000. That was the per year total cost of the year. But we are preparing the financial statements, income statement, balance sheet, or we are calculating the profit or loss of our firm on quarterly basis. So we have done what? We have classified, group our cost on the quarter. So when we classify our total cost on the basis of period, so that classification is called classification of cost, based on accounting period. Right, yes. So this was what this was regarding. This was regarding classification of cost according to the accounting period to which they apply. Now, dears, we are proceeding to classification of cost according to their tendency to vary with volume. We are classifying, we are grouping the cost based on what? Based on the volume of production, volume of sales. So based on production and sales, what we are doing now, we are classifying cost. Now based on volume, we classify, we group cost into fixed cost, variable cost, and semi-variable cost. Fixed means what? Fixed mean constant, variable mean changeable, semi mean a half. Semi mean a half. So now let's have a look at what is fixed cost, what is variable cost, and what is semi-variable cost. So there, as I told you, that by fixed cost we mean that cost which is constant. That cost which is constant. So by fixed cost we mean that cost which remain fixed in total, which remain fixed regardless of the changes in volume of production or sale. For example of, okay, before going to example, let's clarify the term fixed cost more elaborately. Regarding fixed cost, we say that that is the cost which remain fixed. Fixed means constant. This kind of cost doesn't depend upon what? Upon our production or sale. It doesn't depend upon the production or sale. How? For example, if in our organization, if in our factory, let's say we have hired a building, we have rented a building. So we are paying a rent of the building. If in that building we are doing what? If we are manufacturing 1000 chairs, or if we are manufacturing 1 chair, or if we are manufacturing 0 chairs, mean no chair, but we will be required to do what? We will be required to pay the rent of the building. Now that rent is what? That rent is our fixed cost, because rent, that cost, this is the cost which is not related to the production or sales. Why? Because if we make production or not, but we are required to pay rent of the building. And the owner of the building, if we ask him that, sorry sir, in this month we didn't produce or we didn't sell anything, kindly waive off the rent to us. So what do you think? The owner of the building will waive us rent? No way, no way. The owner of the building will ask you that whether you make production or not, whether you sell or not, but you need to pay me the rent, right? So such kinds of cost which doesn't depend upon your production or sales, so such kinds of cost are known as fixed cost. For example, rent, sorry, depreciation. Regarding depreciation, we know that depreciation is the gradual decrease in the value of an asset is called depreciation. For example, in our factory, if we suppose in our factory we have a computer, right? We have a machinery. Now let's take the example of computer. If we use computer or not, but the value of computer will diminish with the passage of time. So that value which decreases, that is called what? That is called depreciation, right? So depreciation is the fixed cost. Insurance, if you have made insurance of your machinery, building, employees, and so on, so whatever you do, whether you produce or not, but we are required to pay insurance to the insurance company, and same the cases for your executive salary. So these are few of the examples of the fixed cost. So regarding fixed cost, we said that the cost which remain constant regardless of the production. Clear, dears? Okay. The other one is variable cost. Fixed cost was not related with the production or sales, right? Whereas variable cost is that cost which varies with the production and sales. When our production enhance, boost, so at that time we will be required to pay more. If our production or sales will be reduced or on decline, so we will pay lesser. So in simple words, variable cost is a cost which varies, which change with volume of production or sales. If we will make more production, we will be required to make more payment for these costs. But if your production is zero or if it reduces, so accordingly we will, our variable cost will also diminish. For example, okay, now what we say in this definition, these are those costs which fluctuate in proportion to the volume of production, which fluctuate, which change with the volume of production. The variability may be in direct proportion to the volume of production and at the same rate as the quantity or volume of production changes. Mean that the variability, the changes in the variable cost, it's not necessary that our production or sale has increased 100%, so this variable cost will also increase 100%. No. If our production or sale increase 100%, it might be possible that the variable cost may increase 50%, 70%, 90%, or 120%, right? So it is not in what, it is not at the same rate at the quantity or volume of production changes. For example, the example of variable cost include direct material, direct labor, fuel, power, etc. Now, indirect material. So, direct material is one of the variable cost. Why? Suppose if you are manufacturing a chair, so we will be required a specific amount of wood and steel, right? But if your production increases from 1 to 50 chairs, from 50 to 100, from 100 to 500, so definitely as the number of chairs we are going to produce more, manufacture more, so the direct material, mean the wood and steel, that will be used more in that on those chairs, so that will also increases, that also increases. Same the case is with the direct labor. So if we are manufacturing one chair, so we are required to pay salary and wages to only one labor or two or whatever, as per the requirement we will make payment. But if our production increases from 1 to 500 chairs, so definitely for 500 chairs, for 1000 chairs, we are required to increase the number of labor. So when we will increase the number of labor, so we will be required to pay more salaries and wages. So that is also one of your variable cost. Fuel, definitely, if production increases, so we may need more petroleum, diesel, or etc., or coal, right? Same the cases for the electricity, same the case. So these are few of the example of variable cost. So variable costs are those costs which varies, which change with volume of production and sale. So what are the examples in a manufacturing organization? That is direct material, direct labor, and fuel. So these are few of the example, but it might be possible that you are working in any services organization, so definitely the variable cost will also change. The nature may be different. There, here we have used direct material, direct labor, and so on. It might be possible in those organizations, it may be different. Now the next one is semi-variable cost. Semi-variable cost are those costs, one part of which is fixed while the other is variable. Those costs, one part of which is fixed whereas the other one is variable. So such costs are called semi-variable cost. Such kinds of costs are called semi-variable cost. For example, telephone or electricity bill. Now in electricity bill, look dear, if we consume electricity or not, but we are required to pay a specific sum of charges to the government, say 500. 500 is the fixed charges we pay if we use electricity or not, even if our home, factory, office is locked. But again, on monthly basis, we will be required to pay the electricity bill, and it is 500. But when we open the lock of our office, home, or organization. So definitely we will consume electricity. So when we will consume more units of electricity, so what will happen? We will pay more based on the units which we have consumed. So electricity bill is one of the example of your semi-variable cost. Why? Because in electricity bill 500 is suppose constant fixed we must pay, and as we are consuming more units of electricity, so 500 plus the additional units which we have consumed, so we will pay for that as well. So that cost of which one portion is fixed whereas the other one is variable, so such costs are called semi-variable cost. Salaries of supervisor, if we are paying for supervisor for any other worker, if their salary is fixed, but sometimes if they perform some additional task and organization pay the overtime, so that overtime is what that is the variable. So anyway dears, these are the two examples, but in your life, in your organization, you may find many more. So what I mean to say that by semi-variable cost, we mean those costs which remains what? Which out of which one part is fixed while the other one is variable. Now come to the classification of cost for decision making. Cost classification for decision making. So there it is important to realize that every decision involve a choice between at least two alternatives. What I say? Every decision, every decision involve a choice between at least two alternatives when we are making decision. So definitely there will be two alternatives. So what we do? So selection or choosing between two alternatives, between A and B. Suppose we are selecting one, so one is our decision that we have selected one. So the choice between at least two alternatives, that is called what that is called classification for decision making. So that was a decision which you have made, that we have selected B. Right? Now dears, the goal of making decision is to identify those costs that are either relevant or irrelevant to the decision. Clear? What I say? That the goal of making decision is to identify those costs that are either relevant or irrelevant to the decision. Cost and benefit. Cost and benefit that differ between alternatives are relevant in decision. Cost and benefit that differ between alternatives are relevant in decision. All other costs and benefits are irrelevant and can be and should be ignored. What I say? Those costs and benefits they differ between alternatives are relevant in decision. All other costs and benefits can and should be ignored. Now it will be clear from this example. Uh, Remember dears, for example, you have a job. Assume that you have a job paying 1500 per month in your hometown. Clear? You have a job, you are receiving 1500 per month in your hometown, near to your home. Suppose in what? In let's say Behsud. Alright? You have a job differ in a neighboring city that pays 2000 per month. You have a job offer in suppose in let's say Surkhrut, right? You have a job offer in neighboring city that pays 2000 per month. The commuting cost to the city is 300 per month, right? Now dears, what we say, the differential revenue is 2000 minus 1500, 500. Differential cost is 300. Differential cost is 300. So what we say that, sorry, So what we say that this 500 is differential revenue and 300 is the differential cost. This differential cost is also known as incremental cost. This is also known as incremental cost, is a difference in a cost between any two alternatives. Between these two alternatives, this 300 is the differential cost. A difference between a revenue, 2000 is the revenue, 1500 is revenue. This is the earning at the moment, whereas you have got an offer of 2000. So this 500 is the differential revenue. So what we say, a difference in a revenue between two alternatives, this and this alternative is called differential revenue. This differential cost can be either fixed or variable. Either fixed or variable. Anyway, dears, so this was what this was, the classification of cost for making decision. So we need to keep in mind the differential revenue and differential cost. That what is the cost which we will bear if we attain an opportunity, and what will be the revenue we will generate if we will avail an opportunity. So this was what this was, differential cost and revenue after substitutes or alternative. Now come to the point, that is the opportunity cost. There's opportunity cost is the value of something. Opportunity cost is the value of something when a particular course of action is chosen. Simply put, the opportunity cost is that you must forego in order to get something. Clear? What I say? The opportunity cost is what you must forego in order to get something. In order to obtain something, when you forego something, that is the opportunity cost. Now, come to the definition of opportunity cost. What I say, the potential benefit that is given up. The potential benefit that is given up or for which you forego when one alternative is selected over another. When one alternative is selected over another, between two alternatives you select one. You select one. So that is what? That is the opportunity cost. Now let's make it clear. At the ice cream parlor, you have to choose between Rocky Road and Strawberry. Right? At ice cream parlor, you have to choose between two. Between what? Rocky Road and Strawberry. When you choose Rocky Road, the opportunity cost is the enjoyment of strawberry. So this is the opportunity cost. Now come to another example. A player attends baseball training to be a better player instead of taking a vacation. The opportunity cost is or was the vacation. Clear, dears? So in opportunity cost, what we say? Opportunity cost represent the potential benefits an individual investor or business misses out on when choose one alternative or another. Mean when you select one and lose the other one. So the one which you lose, that is the opportunity cost. That is the opportunity cost. Clear, dear? Okay. Now, moving to the sunk cost. Now, what is sunk cost? Sunk means simply drowned. Sunk means drowned, right? We say that ship has drowned. So sunk cost. Now, sunk cost is what? A sunk cost is a cost that has already been incurred and cannot be changed now or in the future. Mean the cost which you have incurred, and you cannot roll back your decision, and you cannot change it now or in the future. This kind of cost is called sunk cost. Right? Now have a look over this. What we say, a sunk cost refer to the money that has already been spent and which cannot be recovered. Is it clear? What I say, a sunk cost refer to the money that has already been spent. You have spent a specific amount of money and which cannot be recovered, and you are unable to recover that. So that amount which you have spent and you cannot recover, so that is called what? That is called sunk cost. In business, the axiom that one has to spend money to make money is reflected in the phenomena of the sunk cost. A sunk cost differ from future cost that a business may face, such as decision about inventory purchase, cost, product pricing. Sunk costs are excluded from the future business decision because the cost will remain the same regardless of outcome of our decision. So what we said is, remember that what is sunk cost? Sunk cost is the cost which you have incurred and you cannot get it back. So that is what, that is the sunk cost. That is your sunk cost. So regarding sunk cost, further what we say, that sunk costs are those which have already been incurred and which are unrecoverable. Which is unrecoverable. In business, sunk costs typically not included in consideration. In business, sunk costs are not included. Sunk costs are not included in consideration when making future decision. When you are making future decision, so sunk cost is ignored, as they are seen as irrelevant to current and future budgetary concern. So simply, sunk costs are in contrast to relevant costs, which are future costs that have yet to be incurred. There are two kinds of cost. One is future cost, one is the sunk cost. Is the cost which you have incurred, which you have paid, and you cannot recover it. So that is the sunk cost. Whereas the future cost is that cost which you haven't paid yet, which you haven't paid yet. So sunk cost is not useful in the decision making for the future, whereas the future cost is helpful for decision making. Although if once we experience something, so definitely in future we will not revise, we will not repeat. So that is a kind of experience. But in monetary terms, in financial terms, when we are making decision regarding a particular cost, so we ignore sunk cost. We ignore sunk cost because they are not carried forward in the future, whereas we keep in our consideration the future cost. We keep in consideration the future cost. So dear, this was something regarding classification of cost, that how can we group our cost, right dears? So in our coming class we will move to the CVP analysis and break-even point analysis. So I will suggest that all of you must watch these two videos, mean the classification of cost part 1 and part 2, in order to better understand the CVP and BEP analysis. One thing dear, I will suggest that all of you must study these financial and cost summary statement. I do accept that you have studied these in your financial accounting, that what are financial and cost summary statements, what are the trading cycle, what is the manufacturing cycle, right? How can we prepare income statement in a trading concern, and how can we prepare income statement in a manufacturing concern? So here in both the statement you can see cost of goods sold in manufacturing firm as well as in the trading concerns, right? Mean the income statement format is means sales, good, gross profit, operating expenses in manufacturing and trading concern as are same. but the difference is in calculation of cost of goods sold in manufacturing firm. Right, dears? So that is the difference. Anyway, dear, thank you so much for your kind attention. Inshallah, in our coming session, we will start our new topic. Till then, take very good care of yourself. Inshallah, see you in our next session. Allah Hafiz.